Hi everyone, thank you for joining us for our True Option Masters weekly video. I'm Amber Hestla and I'm joined by Mike Carr. Mike, this week we wrote a lot about bear markets and there's a lot of research on that topic in those articles. But now I was just hoping you could talk to me a little bit about what you learned from the bears experience.
Okay, I think that's a great topic because we are most likely in a bear that is going to last for quite some time. I'm going to do a very quick screen share here, and I want to look at a bear market that taught me the biggest lesson from the 2008-2009 bear is bears don't necessarily end quickly. So the first leg of that bear market lasted about 190 trading days and pushed prices down about 20%. That's where we are now. I think we're at 199 as far as trading days go in the current bear market. So maybe a similarity here. After that, we got a rally. I was trading back then. Everyone thought that's it. The big one is over. In 28 trading days, so that is less than 2 months, 36% decline. This was Lehman Brothers. After the election, we got a 27% decline in 3 days. Then in March, we got a 24% decline in 3 weeks. These things happen. The bear market is not going to just cooperate with everybody. So everybody right now seems to think we're just going to get a nice, easy 20% decline, V bottom, prices rally. 2008, 2009 showed us that bears last quite a while. And what I've learned is it's important to expect the bear to continue. Okay, now, you haven't been trading through as many bears as I have. I think I have 5 under my belt. You don't have that many. So what have you learned?
I like how you phrase that. What have the markets taught you? Because the markets are a teacher, and the truth is they are an expensive teacher. And I did learn that in that brief bear market of 2020. During that time, I was selling put options, and so put options increase in value when prices fall. And if you buy a put, you can profit in a down market because they rise when prices fall. Puts decline in value when prices rise. So if you bought that put, you will lose money, if the underlying stock rises. But you have to remember there are 2 sides to those trades. If you buy a put, someone has to sell it to you. So that makes money if that person makes money if you lose money on the trade. So to get around that, I created an indicator, and it was a great strategy. It won over 90% of the time. And then the pandemic hit, and in March 2020, the economy just shut down. And during that time, of course, stocks sold off, and it was the fastest bear market in history. So most people, I did suffer a few losses. I think it was about 3. And those losses wiped out more than we had made in 6 months. So naturally, I was dismayed, and I was aware that it could keep happening. So I began a research project. I created a list of previous black swan events and discovered that there's really no way to avoid occasional large losses with that put selling strategy. But there was a way to reduce risk, but not altogether. So I had lost 6 months of income. My research revealed I could lose even more the next time. So how I was motivated to keep generating income. And while reviewing other approaches, I found a way to fix the problem with a strategy involving spreads. So some of you might be familiar with those, but they do require entering orders for multiple option contracts at one time. For example, we can sell a put for income and buy a different put to limit risk. These trades fix the problem with a traditional put selling strategy. We receive income immediately. Of course, that met my immediate goals. It also limits risk, which attains the primary goal. An additional benefit is that these trades require a small amount of capital. So those trades require less than $500, and sometimes it's even less than $250. With that other put selling, It requires thousands of dollars of capital just to open a trade. So of course there is a downside to this other strategy because it does require low amounts of capital. They often generate less income, and it can be $50 per contract. So the way to overcome that shortcoming is we just trade more often, and it's a strategy that's been working pretty well in the bear market.
Yeah, I do want to talk more about spreads, and we'll do that probably next time or the time after. But for now, I think we're about out of time. We ran a little bit longer than we planned. So we'll wrap up here. And again, if you like our content, subscribe, like the video, comment below, let us know what you're thinking, and we'll be back next week. Thank you.
Thanks.